Hello, Assalamu alaikum everyone. Hope everyone is okay. Thanks for attending today's event. Firstly, let me thank everyone for signing up to our online service. So really appreciate you being our clients. I'll just go through what the agenda for today is. Uh, so hopefully everyone can see my screen. Now, I think there's sort of three key things which I'll be talking about. I think first would be educating everyone on the tax allowances and the tax rates which are applicable within this tax year. Secondly, I'll go through 10 financial planning tips which may be useful for a lot of the audience. And third, it's about going through the platform functionality, which is the online system which you use. So I'll go through those step by step, and I think that the most important sort of bit of this event would be the Q&A session, which would happen at the end. In the meanwhile, you can leave your questions in the YouTube comment box, and I'll take those at the end of the presentation. Just a quick disclaimer, nothing in this presentation should be taken as been giving personal advice. And just to be mindful that when you do ask any questions, please do keep your personal information, i.e. your account number and other key information confidential, please. Thank you. So the first bit I'll go through is educating everyone about the tax allowances. Now, the first allowance and the tax rate which is relevant to everyone and everyone who works, which is most of the people would understand this. So the first £12,500 that everyone earns, it's not taxable, it's totally tax-free. The tax year starts from the 6th of April to 5th of April. It's the first £12,500. There is no tax. Thereafter, until £50,000, any income is taxed at a rate of 20%, and those who earn above 50k up to 150k, the tax rate is 40%, and after 150k is 45%. For those earning above 150k. So that's a quick snapshot on the income tax rate. One thing to be mindful of is when a person starts earning above 100k, their annual personal allowance would reduce by £1. They would lose £1 of personal allowance for every £2 they earn. So that's something to be mindful for those individuals earning above 100k. Every individual that works and earns a certain amount of money, they would pay national insurance on the income that they earn, and essentially any income earned above £9,500, there is a 12% national insurance which is paid by the employee, and the employer has an obligation to pay national insurance, which amounts to 13.9%. The second allowance which everyone should be mindful of is the personal savings allowance. Now, every individual, again, every tax year from 6th of April to 5th of April gets the savings allowance, which for a basic rate taxpayer, which is a 20% tax rate payer, it's £1,000. For high rate taxpayer, which is a 40% bracket, it's £500. And the savings sort of income includes, I suppose, the interest income that one gets from deposit accounts with their banks, or it could be profit rate, which people may benefit from through their Sharia compliant bank accounts. So that allowance is on top of your income allowance, your personal income allowance of £12,500. Now, those individuals who are earning less than £12,500, there is something called a starting rate savings allowance, which amounts to £5,000. Now, the key thing when it comes to investing, which is very much relevant for those investing in stocks and shares, is to be mindful of the dividend allowance and the capital gains tax as well. Now, every year, up to £2,000 worth of dividends are tax-free, and thereafter, depending upon the individual's tax rate, the tax can range from 7.5% to 38.1%. Then there is also a capital gains tax, which applies on essentially the gain you've made. So if you buy an investment worth £1,000 and it goes up in value to £1,500, and if you sell it at £1,500, the extra £500 on top is your profit or a gain, and it is considered as being taxable for for capital gains tax purposes. But the key thing which is important and to be mindful of is that every person every year from 6th of April to 5th of April, they benefit from the capital gains tax allowance, which is £12,300. So the first £12,300 you make on your investments, there is no capital gains to consider. After utilizing that allowance, based on your tax rate, if you're a 20% tax rate payer, then you would be liable to pay 10% capital gains tax, and it's 20% for those with those paying 40% or 45% tax rate. Now, one of the key things to sort of point out is the capital gains tax is that applies on shares is different to what may apply on a second property. So if you have a second property, you've rented it out and you do intend to sell it in the near future, when you do sell it, the capital gains on such assets would be much higher, which for a basic taxpayer would be 18%, and for a higher rate taxpayer it would be 28%. So I think the whole idea of actually going through taxes was to help everyone really understand the type of taxes we incur when it comes to income, and also the gains that we make, because that would help every individual decide what type of account is suitable for them, and getting the right mix of accounts is also useful as well. Now, it's important to really understand how your investments are taxed. So I've got all these sort of three categories of investments which form part of most of the portfolios which you all have, and I'll just quickly run through where each of what type of tax is applicable to all these investments. So if you look on the right hand side, you would see that any gain that you make on all of the investments is subject to capital gains tax. But obviously you have the capital gains allowance of £12,300 every year, which can be utilized for that purpose. So any investment which you hold with Simply Ethical, if it does go up in value, then the capital gains tax comes into play, but obviously you have the allowance there to benefit from. Now, what's important to sort of understand is when it comes to Sukuk or Islamic bond investments, and I've outlined so 3 investments, Franklin Fund and 2 funds by Oasis Crescent. For those 3 investments, they pay an income. In the case of Oasis funds, it's every month they will pay a certain income that you would have seen in your accounts. And in the case of Franklin Fund, they pay a quarterly income. So every 3 months they would pay a certain income. Now, from a tax perspective, that income is treated as an interest income purely from a tax perspective, and that's where you could utilize your normal personal income allowance of £12,500, or in addition to that, you have your personal savings allowance, which can be utilized for this type of income. So for basic rate taxpayer, it's £500. For higher rate taxpayer, it's £1,000. So which means essentially any income up to £500 for a 20% taxpayer, there is no tax to consider unless they go above that £500 limit. When it comes to investing in direct equities, global equities like iShares, World Islamic ETF, and the Emerging Markets ETF, both of those investments pay a quarterly dividend. So every 6 months they would pay a dividend, and this is essentially because these funds hold a number of companies. Something I'll go through the type of companies which are held by these funds. When they share their profits with the shareholders, then the income that one benefits from is called dividend. And here you have your dividend allowance, which is £2,000 for every tax year. Anything above that, there would be dividend tax on it based on the individual's tax rate, basically. So in terms of where your money is invested, I've just taken a quick snapshot of 5 funds that we invest in, and essentially, by and large, a lot of the portfolios have exposure to over 700 plus companies. I'm sure you would recognize a lot of these brands, like Tesla, Apple, Nestle, which you all recognize, and I suppose a lot of us may be consumers of the goods from these companies. So all of these companies are part of your portfolio, including with a lot of our portfolios. Actually, all of our portfolios also have holding or exposure to physical gold. So that's also part of your portfolio. And for those with relatively higher risk portfolios, they've got a certain amount or certain proportion invested in relatively high risk physical metals like silver, platinum, and palladium. So again, investing with any portfolios with us gives you a very diversified range of investments into globally recognized companies. Now, I'll go through the tax year end financial planning tips. I've got some 10 tips to consider. There are a huge number of tips that I can go through, but I've devised and come up with these tips based on the audience which is present today. And one thing which you'll realize, I think, as I go through the presentation, is not every tip may be relevant to every person, but once I've gone through that 10 tip, I can assure you that there will be something in it for everyone, inshallah. So I'll go through one by one. The first thing that one should consider is to maximize their ISA allowance. Again, the reason you do that is to mitigate any potential dividend tax which might come into play, mitigate any interest type of when it comes to Sukuks do pay income which is treated as interest income, and hence if you've got all your investments in an ISA, then you don't have to worry about capital gains tax, or you don't have to worry about any other type of taxes. So again, having investments in stocks and shares ISA or junior ISA, it's something that anyone should consider. Now, the ISA allowance, which for adults, which is £20,000, that can be shared between your cash ISAs and your stocks and shares ISA. So, for example, you could have £5,000 in a cash ISA, and you may decide to have £15,000 in a stocks and shares ISA. So you can mix and match as long as the maximum you contribute is £20,000. So there is a limit of £20,000 that applies to adult ISA, which is a stocks and shares ISA. So I'll go through each of those in the next few slides. So again, £20,000 is what you can put in every year. You with the ISA allowance, you cannot carry that forward. So once you've missed out the ISA allowance for this year, it's gone. It doesn't come back. So every year, every individual gets £20,000 worth of ISA allowance. There is no tax. There's no income tax or capital gains tax within an ISA. You do not need to declare that this whatever gain or income that you make within an ISA, on your tax returns. So that's not needed. What may be useful for individuals who've got large amounts of money and they are married is to consider possibly utilizing their full allowance, but also utilizing their allowance for their spouse. So essentially, if a couple couple can sort of shelter up to sort of £40,000 worth of investments, £20,000 each. So that's something to consider. Now, one thing to sort of be mindful is that when you transfer your existing ISAs with any previous provider to a new provider, now that's not considered as counting towards your ISA allowance. So it's just what happens in practicality is simply the change of provider. It does not have any impact on your ISA allowance for the year, for the current year, or for any other year when you do the transfer. In terms of individuals who are looking to make ISA contributions within this year, you're advised to fund your accounts before 30th of March, so you can sort of benefit from this year's tax allowance. I'll go through shortly how to make payments through our online system. Now, other thing, the second tip which may be useful is that it might be the case that some individuals may have their investments in a general account, and let's say a person has £10,000 in a general account. Now, what they could possibly do in this particular tax year is what's called bed and ISA, which essentially means you would sell your investments within general account, and then you would move the cash from the general account into your stocks and shares ISA, hence utilizing the allowance for this year, and then buy back possibly those same assets within a portfolio. Now, one thing to be mindful of is every time you buy sell something and then you buy something else, there may be a bit of a time lag where potentially one can lose out on potential gains. So that's something to be mindful of. And secondly, when you do buy investments, then generally the cost of buying investment is relatively high, slightly higher than the cost of selling. So that the cost implication has to be considered. But generally, purely from a tax perspective, is selling investments in a general account, making the most of your capital gains allowance of £12,300 if it's there, and then transferring money to an ISA is something that may be relevant and can be considered by some of the audience here, basically. Again, if someone wants to sort of move their general account to an ISA or to a pension, we call it bed and ISA, or bed and pension. If they want to do that, then we would need instructions from our clients by the end of by the close of 28th of March by email. So do let us know if someone does want to sort of consider this as an option. The third tip I have is to make the most of the junior ISA allowance. Now, apart from the £20,000 ISA allowance, which is there is also something called junior ISA allowance, which is £9,000 every year, every tax year. and that applies to every child. So if you've got 2 children, that's 2 lots of £9,000. Again, the same. It works in the same way. There is no tax, income tax or capital gains tax, while the money is invested in the junior ISA. The key thing to be mindful of is that once the money is transferred, once the parents or those making contributions to a junior ISA, once they've made those contributions, then essentially, technically, the fund actually belongs to the child, and the parents, are essentially taking care of those funds until the child turns 16, when they can take control of the account, and then when they turn 18, basically they can actually access the money directly. So the key thing is that once the funds go into a junior ISA, they are not accessible until the age of 18. And when it is 18, when a child is 18, then the funds can be withdrawn directly by the child. Now, the junior ISA can be quite useful for those individuals who are quite wealthy and they need to reduce their the wealth that they have to mitigate their potential inheritance tax liabilities. So they could potentially use the annual gift exemption, which is £3,000 every year, which also can be carried. You can go 1 year back and carry forward the £3,000 allowance for the previous year if you have not used that. Or there is something called making gifts out of income, which are free from inheritance tax. So it can be quite useful to look at ISA. It might be the case that you might want to set up an ISA for your kids for university fee, and so that's one. And secondly, to transfer some of your wealth to mitigate your future inheritance tax liabilities. So this is I think for me is a top tip. I think quite easy for everyone to understand. Most people can do it. It's just the power of saving a small amount, but keeping it very consistent and on and doing that on a regular basis. So I've shared those figures here with you, which assumes that a person invests £1,000 initially, and then every month they would put in £100 a month for 18 years. So essentially, when a child is born, you put in £1,000 in the JISA or any investment account of your choosing, and then every month you can top it up by £100 a month. And what that means is, after 18 years, based on 5.2% growth rate, the pot could amount to around £33,000 plus. This is in today's money, which is taking into account inflation, which is assumed at 2%. Now, what that means is potentially, university fees are around £9,000. So potentially, if someone follows that regular monthly payments with a small initial startup, after 18 years, inshallah, hopefully, with the growth of 5.2%, they could expect that that they're able to fund 3 years worth of university fees from this particular pot. So again, it may be useful to look at this as an option. Fourth thing is that we do encourage a lot of our clients to start looking into pensions. Now, that could be from, doesn't have to be a private pension with Simply Ethical or any other private provider. You should consider making pension contributions through your employer as well, if they have a Sharia compliant option, because you would benefit, one, from the tax relief. And I think the second thing is, when you make a contribution, then, based on the amount you earn, the employer also has an obligation to make a certain contribution, which you can benefit from. So do consider pensions if someone is not contributing towards it. The great thing about pension is once your money is in a pension, there is no income tax to consider. There is no capital gains tax to consider. It is pretty much grows tax free while it is in the fund. And one of the most attractive features of pensions is the tax relief you get. So if a person who is a 20% taxpayer, which is the basic rate taxpayer, if they pay £80 into a pension, they would get 20% tax relief. Likewise, if someone is a 40% taxpayer, if they pay £60 into a pension, then they would get 40% tax relief. So in a nutshell, rather than your tax going to the HMRC or the taxman, essentially it ends up in your pension pot, basically, and it obviously grows over time. The one, I suppose, the drawback to consider is that once you put money into a pension, it is not accessible until the age of 55. So it is for those investing for a very long period of time. But again, it's something to consider for individuals who haven't got a pension in place. The fifth tip is to fully utilize the annual allowance. Now, every year, one can make up to £40,000 worth of pension contributions. It's £40,000 or their salary or whatever they earn, whichever is the lower amount. That's what they can pay into a pension and get a tax relief. So, for example, if a person is earning £25,000, then the maximum they can put into pension is £25,000 and get a tax relief on it. And if someone is earning, let's say, £80,000, then the maximum they could put into a pension is limited to £40,000, and they would get tax relief on any amount up to £40,000. Now, there is an option for individuals to carry forward their allowance for the previous 3 years. So if you haven't used your 40k allowance, for the previous 3 years, then potentially you can move those forward. So which means essentially in one particular tax year, assuming if you haven't made any pension contributions in the previous 3 years, then you could essentially make even up to 160k worth of pension contributions into a pension. Again, there are certain rules which one has to be mindful of, but the possibility of making higher contributions than £40,000 is possible, but it depends on individual circumstances. So I've given an example of how the carry forward allowance works. So as every year, if you look at the table there, from the tax year 2017-18 to the current tax year, every individual has a 40k allowance, and I've assumed that the person puts in £30,000. They made £30,000 worth of pension contribution in 2017, 10,000 in 2018, and 2019 they made £15,000. The difference between the annual allowance and the contributions they have made in each tax year is the remaining allowance, which they can carry forward. So you would see that from the previous three tax years, from 2017 to 2019-18, essentially this person here in this example could carry forward £75,000 worth of those allowances and use also the existing allowance, which is £40,000. So essentially, in this case, this particular person can make around 105k worth of pension contributions. Now, the tax relief is limited to how much you earn, so that's something to be mindful of. Number 6 is don't overlook the spouse who's not earning. So a lot of people may be married, and then one of the persons in the family might be working, and one person might be a homemaker, and it may be worth, obviously you may have utilized your pension allowance and made the contributions through your workplace pension, and also benefited from the contributions being made from the employer, which is good. But what would be useful is also to consider setting up a pension for your spouse, where even if they don't earn any income, they can still benefit from 20% tax relief. So essentially, if one was to put in £2,880 into a pension for a person who does not earn, the taxman will top it up, top up the other 25%, and the pension value will go up to £3,600. So there is a potential £720 worth of sort of nominal gain or 25% gain that can be made. And also the key thing is that you are planning for the retirement years, not only for yourself but also for your spouse as well. So again, it's also be mindful of your couple and try to use the allowance for them as well. Tip number 7 is to also consider junior pension. Now this is again quite useful for individuals who are looking to reduce their estate to mitigate future inheritance tax liabilities, and it works quite well for them. And again, one can benefit from 20% tax relief on contributions up to £3,600. So it kind of works in a similar way to a pension, to a pension contribution where where a person is not earning anything. So again, considering junior pension for your children is also a good way of mitigating your potential inheritance tax liabilities, but also I think making sure that the kids in their retirement years have a reasonable pot of pension which they can enjoy in their future years. So this is a very, very long-term planning, and it should be considered for relevant individuals. Now, the key thing again to be mindful of is once the child turns 18, then the control of the pension would transfer to the child. So it pretty much works in a similar way to in terms of control to a junior ISA, where when a child hits 18, it is their money and they have full control over that amount. The 8th tip is it's relevant for individuals who are earning between 50k to 60k, and they may have kids. Now, if a person is earning above £50,000, then and they have children, young children, then for every £100 that you earn above 150 or above 50k, your child benefits are reduced by 1%. So by the time a person has earned 60k, all the child benefits could be wiped out. Now, one of the options which may be worth considering for those individuals who've got young children and are earning between 50 to 60k is to consider making pension contributions through workplace pension or the pension of their choosing with us or with anyone else, and that would help reduce their adjusted net income, which is the relevant sort of figure from the taxman perspective. And once your income reduces to 50k and below, then you can recoup your child benefits back. So essentially, if one was to, make pension contributions and reduce their income up to 50 and below, then essentially the marginal sort of benefit to them amounts to around 58.2%, which can be quite useful. Now, for those individuals who are earning more than 100k, plus, or between 100 to 125k, as sort of pointed out earlier, if a person earns more than 100k, then their personal allowance is tapered away at a rate of £1 for every £2 the person earns. So again, a possible option for such individual may be to consider increasing their pension contributions to reduce their income. But again, the total benefit to them would be that because for anyone who's earning above 100k to 125k, the essential income tax rate works out to be 60%, because obviously they would be paying 40% on any income above 100k. But also, the more they earn above 100k, their personal income allowance of £12,500 goes down, which means essentially there's an additional 40% tax which becomes applicable, and in total it's 60% marginal tax which a person may end up paying, and hence pension can be a good option for individuals to consider. There are also other options, sacrificing your salary and making your contributions into a pension, and also agreeing with your employer to potentially put in more contributions to account for the amount they've saved on the employer NI contributions. But when it comes to salary sacrifice pensions, or if you're looking to reduce your salary for the sake of increasing your pension contributions and making it very, very tax efficient, I would encourage anyone considering that to seek advice before taking any action. The last tip is for individuals who are self-employed. They might be small businesses, with 2-3 people, or one-person firm, for example. Now, what they can do is their company can make an employer contribution on their behalf, and any pension contribution is deductible as an expense, and the company would benefit from the 19% tax relief. So that's something to be mindful of. And I've just given an example of a person who's got a company with a person who's got £10,000 worth of profit. Now, if they were to take that money out, then firstly, the company will have to pay corporation tax at the rate of 19%. Then the company would declare dividends and pay dividends to the individual. And I've assumed here that the person is a high rate taxpayer. Now, essentially, the amount that the person would end up would be £5,470. So there is over sort of 45% tax for that individual. Now, an option which may be worth considering for such individuals, self-employed business owners or directors, is to consider making contribution into a pension. They would benefit from the corporation tax relief, and they can also not pay any dividend tax. So essentially, a 10k pension contribution could save such individuals, over £4,500, which is quite useful. So these are the sort of 10 tips which may be relevant to a lot of the clients we have today. Now, I'll go through the online platform functionalities. A lot of the individuals would know how the platform works, but it just might be worth spending a few minutes just to go through some key features so that everyone understands how to use the platform. So in terms of making contributions, you would need to click on deposit and withdraw option. Then make sure you pick the right goal. Depending, if you're looking to fund your ISA account, then click on that. If you're looking to fund your retirement or a pension, then make sure you click the relevant account, and then thereafter click on deposit. Now this is for making one-off deposit into your account, and then after that is simply the case of putting your the amount that you're looking to make, the amount that you're looking to deposit with us, and then click on deposit, and the system would give you the bank details and the reference number to make those payments from your personal bank account. So this is how to make the one-off contributions. In terms of regular contributions, again, it's going into the same option of deposit and withdraw. Make sure you choose the right goal, and then click on the recurring deposit tab, and you can select direct debit. And again, you can choose the amount and the day, and have the account set up. Now your bank details would already be pre-filled. You see it blank because this is just for the demonstration purposes, but that information along with the payment reference would be pre-filled when you land onto this page. Once you've completed and clicked on the create recurring deposit, then you should receive an email requesting your signatures on a direct debit form. Now, one of the key things to be mindful of is to make sure that you check your profile section. Now, the online service is an advice solution, and hence what everyone should do is to consider redoing the risk assessment every 180 days. So anyone who's had an account with us for over 180 days would have this button called update in green, which would appear in their profile section. Once they click on that, then they will have the option to redo the risk assessment again, and the system would recommend them the suitable portfolio for which is relevant to them, and then they can update the portfolio accordingly. So it is an ongoing process where you would need to update your risk profile every 180 days. Now, your perception of risk when you set up an account with us may be different to what it would be in 6 months' time, purely because your circumstances may have changed. You would have seen your investments go up and down. It could be more than what you expected. It could be less than that. So your perception of risk and your attitude towards risk would change, and hence it's important that everyone keeps their profile updated just to make sure that their investments are on track in line with their risk profile and their objectives. You can set up another account. So if you have, let's say, an ISA with Simply Ethical, you can set up a pension account if you want to. And the easy way to do that is to simply on your main page, which is your dashboard, is to look for the button called Add New Goal. Once you click on that button, then you can pick the relevant account and just follow the journey on the system. How to transfer other accounts? Again, you may have set up an ISA account or general account or a SIPP or all of them, and it might be the case that you may have other pensions or other ISAs with other providers which you may want to transfer today or perhaps in the future. Then all you need to do is to go in the deposit and withdraw section, click the relevant goal, which is the relevant account, and then simply go on to the account transfer, and then you would complete the key information like the name of the provider which you're looking to transfer, along with the address, rough estimate of the value of that account, and then your policy number or reference number for the previous policy would be needed. So those details would be would need to be completed. Once you submit this transfer form, then you should get an email from us requesting on online signatures, which essentially gives us the consent to initiate the process of transferring your previous accounts from where they are to Simply Ethical. Now, once you've initiated a transfer process with Simply Ethical, there is no need to get in touch with your existing provider. So as long as you've done our part of the process, we would actually get in touch with your existing provider and get the money across to us and invest in line with your risk profile. It usually takes around probably 30 days or up to 6 weeks for the money to be transferred. Sometimes it takes longer, sometimes it's much quicker. It really depends on the existing provider, how fast they work. So that's going through the features of the platform. And again, one of the key positive things about this platform is that you could have a number of accounts, be it ISA, pension, and a general account. And we're also looking to potentially have junior ISAs and junior pension for our restricted online service. So this is something to look into. So if there is someone who's interested in such accounts, then do let us know by email. But those accounts, junior ISA and junior pension, is accessible through personal advice service, but not accessible through the online service as yet. But inshallah, in the future, we should have a solution in place. So again, your online system allows you to consolidate all your investments into one, which is simple, easier to manage. Everything is actively managed on your behalf, and the Sharia compliance is there. And one of the key things which inshallah you would see in Ramadan is that we will be sending out some guidance on zakat and the zakat ratio relevant to your portfolio. So do look out for those emails, inshallah. So that's the end of the presentation. I'm happy to take the questions now. Just before that, just some key points is that we've got a lot of FAQs on our website, which has a number of questions, frequently asked questions, which may be useful. Secondly, do look at our blog section, which has a number of articles which may be useful and insightful for the readers. And also do follow us on the social media for any new future events and further updates. The other thing which we are doing for our clients and also for potential clients is offering a free consultation with one of our 3 advisors. You can book those consultations by going online, and the link is something which I've shared. You can see, and also it's easily accessible in the help section on the website. For any ongoing queries and support, you can always pick up the phone to Simply Ethical, or drop us an email at info@simplyethical.com.